Welcome to the Deep Dive. Today we are focusing on the Q3 2025 results from Concentra Group Holdings Parent Inc. We'll just call them ConIn, a major player in occupational health.
That's right. This deep dive follows their earnings call on November 7th. We've gone through the commentary to figure out what's really going on with their growth, their M&A, and maybe the most important part.
Why the stock isn't really reacting.
Exactly. Why, despite a really strong quarter, the market seems a little cool on them.
And that's our mission, to give you the actionable knowledge from this call quickly and clearly. So let's unpack this.
Right. And the place to start is just the headline numbers. Because on the surface, this quarter was, exceptionally strong, a beat across all the key metrics.
So what did the adjusted EPS come in at?
39 cents, which easily topped the 37-cent consensus.
Okay, so a solid beat there. What about the top line? The revenue?
So equally impressive, $572.8 million. That's a 17% increase year over year.
17%.
Yeah, and that surpassed street estimates, which were all clustered around that 566 million mark. For a company this size, 17% is real acceleration.
So when companies grow that fast, you always worry about margins, right?
Yeah.
All the costs of integration, scaling up. Did they manage to hold the line on profitability?
They did more than hold the line. They actually showed some resilience. Adjusted EBITDA was $118.9 million.
Which gives you a margin of?
About 20.8%. And what's really crucial here is that margin is actually a slight gain year over year.
Even with all the new costs.
Exactly. They're absorbing new public company costs, separation costs from Select Medical, and integration costs from the big Novier acquisition. The fact that margins are expanding through all that, it suggests some serious operational leverage underneath.
Management was obviously positive, calling it another strong quarter. But you said it, the market reaction was muted. And that's where it gets interesting. We need to understand the drivers of that 17% growth and, more importantly, the cash flow picture that might be making investors a little nervous. Right, let's get inside the engine. 17% growth is huge. Where did it come from? Was it just price hikes or are more people actually walking through their doors?
It was a really healthy mix of both, which is what you want to see. Total visits were up 9.2% year over year.
Wow.
Yeah, that translates to the company averaging over 55,500 visits every single day.
And what about the other half, the pricing?
Revenue per visit also increased about 4.2% overall. And if you drill down, their main business, workers' comp, saw rates go up 4.7%. So real pricing power there.
Okay, but a lot of that growth must be from the big Novier acquisition they did.
Yeah.
If you strip that out, how did the core organic business do?
That's the key question. And even excluding Novier, the core revenue growth was still a really robust 10.6%.
10.6.
And core visits per day were up a solid 3%. So this tells you the strength isn't just M&A noise. The existing business is accelerating on its own.
Now, you mentioned something interesting from the call, this decoupling from the national jobs data. What did management say about that?
This was, for me, one of the most fascinating parts of the call. Management came right out and said that historically, their volumes tracked very closely with things like the BLS jobs report.
Sure, that makes sense.
But recently, they said the BLS trends have actually been underestimating their volume strength, especially in workers' comp.
That's a big claim. Are they just saying they're gaining market share, or is something else going on?
It's a bit of both. They're basically cautioning investors, not to just look at the headline jobs data and assume you know how Concentra is doing. They think they're taking share and maybe have tailwinds in specific industries where they're dominant. If that's true, it means they might be less cyclical than people think.
That's a critical point. Let's pivot to the segment where that growth is just explosive. On-site health clinics.
Oh, booming is an understatement. On-site clinic revenue was up 123.8% year over year. Now, a huge chunk of that was the Pivot acquisition.
Right. So again, what about the legacy business? The clinics they had before that deal?
Even the legacy on-site business showed incredible organic growth. It was up 17.5% year over year.
So what's driving that?
Management connected it directly to employers getting hammered by double-digit increases in their health benefit costs.
I see. So if you're a big employer and your insurance premiums spike 15%.
Concentra comes in and says, hey, our on-site clinic is a more cost-effective way to manage injuries and preventative care. It's basically a hedge against that healthcare inflation. They are very, very bullish on this segment.
Okay, moving on. A big worry this year was integration risk. Novier and Pivot were huge deals. How are they settling in?
It looks like that risk is way down. The Novier centers are now fully on Concentra systems, the signs are changed, and management confirmed they've already captured about 85% of the planned synergies.
85%, so the heavy lifting is done.
It seems so. And with Pivot also largely integrated, they're now shifting their M&A focus.
Out to the small deals.
Exactly, back to their bread and butter. Smaller tuck-in acquisitions of 1 to 5 centers, they do those at really attractive multiples, less than 3 times EBITDA after synergies.
And beyond M&A, they talk a lot about tech investment, almost like a tech arms race in the sector.
It really is a massive focus. They're trying to build a competitive moat. They talked about digital bilateral interconnectivity with their employer customers.
Okay, translate that for us. What does that actually mean?
It just means seamless automated data exchange. So if you're an employer, you get real-time status on employee visits, faster billing, easier compliance. For Concentra, it means less paperwork. It makes their service stickier, harder to switch away from.
And what about AI? Everyone's talking about AI.
They mentioned new AI initiatives, too. Probably things like automated scheduling, optimizing how patients are triaged, maybe even predicting injury risk for certain jobs. It's about using that massive data set from 55,000 daily visits to get more efficient.
Speaking of infrastructure, there's the long shadow of Select Medical. The separation is still ongoing. What's the latest there?
They said the process is about 2/3 complete in terms of hiring their own staff to replace Select services in areas like HR and IT.
And they have a deadline for that, right? The TSA.
Right. The transition services agreement expires in November 2026. They expect to be done by summer 2026, so well ahead of schedule, which de-risks things a lot. And crucially, they said the extra costs of being a standalone public company are already baked into this year's numbers and guidance.
No surprise margin hit coming in 2026 then.
That's the message.
All right, let's get to the heart of the skepticism. The reason we're even having this conversation. The cash flow.
This is exactly it. This is where the story gets nuanced. Operating performance was great, but the cash flow statement, well, it told a different story. Operating cash flow was $60.6 million, and free cash flow was $40.2 million.
And how does that compare to last year?
Both were down. Free cash flow dropped by about 21% year over year.
Okay, so there's the disconnect. Revenue's up 17%, but free cash is down 21%. Why?
Management was really clear on this. It wasn't weak operations. The main driver was a sharp increase in financing costs.
The debt.
The debt. They had a $25 million increase in cash interest payments because of their recapitalization last year. That, plus a few million in one-time capex for the Novier deal, explains the whole drop.
So the business is profitable, but the debt service is just eating up a lot of the cash. That explains the market's caution. Where does that leave the balance sheet today?
Net leverage is at 3.6 times at the end of Q3, but management was fiercely confident about hitting their deleveraging targets.
Which are pretty aggressive, as I recall.
Very aggressive. They're targeting 3.5 times or less by the end of this year, 2025, and then under 3 times by the end of 2026.
How are they going to pull that off?
They pointed out that Q4 is always their strongest cash generation quarter, which will help a lot. Plus, they say many of those little tuck-in acquisitions they're planning are actually leverage accretive, meaning they're so profitable they actually help lower the leverage ratio.
So they're staking your credibility on hitting that 3.5 target.
Absolutely.
But at the same time, they're not just paying down debt. They're also returning capital to shareholders, which seems contradictory.
That tension is key. So they declared their regular dividend, but the big news was the board authorizing a new $100 million share repurchase program.
$100 million. So what is that signaling?
2 things, really. First, management is confident they can generate enough cash to both service the debt and do the buyback. And second, it's a huge signal that they think their own stock is cheap right now.
Okay, so they're trying to send a message. Let's just quickly cover the guidance. Did they update it for the full year?
They did. They raised the low end of both revenue and adjusted EBITDA guidance for 2025. It shows the momentum from Q3 is carrying into the final quarter.
Which brings us to the big puzzle for you, the listener. You have strong fundamentals, integrations going well, guidance raised. So why is the stock trading 18% below its IPO price?
It comes down to those 3 points of market skepticism we've been talking about. 1, the high leverage. 2, rising interest rates hitting that immediate free cash flow. And 3, The market wants more proof that this volume growth is really durable and not tied to the broader jobs market.
Okay, let's shift gears. Time for our This Is Not Financial Advice segment. So we have this setup. A fundamentally strong business with a lagging stock, an aggressive deleveraging promise, and a new $100 million buyback cannon ready to fire.
Right. And the single biggest risk investors point to is that 3.6 times net leverage. Management has made hitting that 3.5 target by year end the absolute centerpiece of their story right now.
So give us the wild but plausible trade idea based on that dynamic.
Okay. The trade is a tactical long position heading into Q4. You're going long con shares, basically betting on this imminent deleveraging catalyst.
The pitch being,
The outrageous but plausible pitch is this. The moment the company reports their Q4 numbers and definitively confirms they hit that 3.5 times leverage target or beat it, the market's main reason for skepticism just evaporates.
and what happens once that risk is off the table?
That event unlocks everything. It proves management's credibility, and more importantly, it gives them the green light to aggressively start using that $100 million share buyback in early 2026 at what they clearly think are depressed prices.
So the buyback acts as a price floor and a catalyst to start closing that gap toward the consensus price target of around $28.
That's the idea. The whole trade hinges on them hitting that Q4 leverage target.
So wrapping it all up, what does this mean for you? Concentra delivered a technical beat and raised guidance. They're successfully integrating huge acquisitions and are pivoting to a new tech strategy. The big challenge now is just converting all that operational strength into free cash flow and getting that debt down.
Right. The story has shifted. It's no longer about integration risk. It's about execution risk. It's a recently spun out company trying to consolidate a fragmented market. Now all eyes are on those leverage targets and showing that the tech investments are going to pay off.
And we remind you, as always, that nothing discussed here constitutes financial advice. It's just our analysis of the source material. Thank you for joining us for this deep dive.
We look forward to connecting with you again soon.